All right, let's get cracking. Thank you for tuning in to this outrageous predictions 2024 from Saxo with the title "The End of the Road." You can see the graphic there, picturing how we sort of see the world. My name is Peter Garnry. I'm head of the Saxo Strats team, and I'm joined together with some of my great colleagues, including a former colleague, John Hardy, which will be talking about one of our predictions related to the U.S. election. Um, we so what we're going to talk about today is we have 8 outrageous predictions, and to setting the stage, I think it's important to understand where we're coming from. So we there's someone that is not have muted correctly. That is we've come from a period with low inflation, low interest rate, very benign and calm geopolitical backdrop. And after the pandemic, a lot of things have changed. Policy making is much more uncertain. We have had a big jolt of inflation sweeping the world. It's not over yet. I think it's too early to declare victory. The geopolitical landscape is being is showing cracks basically everywhere. We have a globalization that was underpinning this very stable environment for so many decades, which is being unraveled, and supply chains are up for grabs. It also seems like technology is impacting more and more industries and the economy. AI, to take one example this year, but also the obesity drugs are really also potentially going to transform healthcare going forward. So, with no further ado, I will give the word to Kim Cramer Larsen, which will talk us through the first outrageous prediction that we have.
Yeah, thank you very much. I hope you can all see my screen with the first predictions that with oil at $150, Saudi Arabia will buy the Champions League franchise. So the reason for this one is that about 4 or 5 years ago, FIFA tried to set up a Club World Cup with several clubs around the world in a tournament, and with a prize money of around $150 million. This offer was rejected by the biggest clubs in Europe and by UEFA, that owns the Champions League. But as we all know, money is, of course, always the most important one, also for the big clubs and for UEFA. So when dollar will hit $150 dollars per barrel, then and FIFA is now a very good friend with most of the Arabic countries, especially Saudi Arabia, after handing them the World Cup in 2032. And we also have seen the Saudi Arabia more or less buying a lot of the big international football stars, notably with Cristiano Ronaldo. So they also want to move into expanding their, you can say, their sportsmanship around the world. And they are teaming up with the FIFA now, since they are so good pals. And they can now back the bid to more or less buy the European Champions League in a massive bid, and then expand it to a Club World Cup that will take place every year around the world, including clubs from South America, Asia, Arabia, Africa, North America, and of course the majority from Europe. But that was also a part of the sweet deal, or would be a part of the sweet deal, so they get just as many seats or places in the new tournament as they have in the Champions League. So clubs that will benefit from this is, of course, all the big clubs, but from an investment point of view, it will be some of the clubs that are mentioned here on the slide. As you can see, Manchester United, Juventus, Borussia Dortmund, Roma, Sporting Portugal, Sporting Lisbon in Portugal, and Ajax Amsterdam, because they are listed and can be traded on the stock exchange. Unfortunately for investors, some of the other big clubs, they cannot. So that is one of the first outrageous predictions, that oil will go to 150 and Saudi will team up with FIFA to buy the Champions League franchise. Thank you very much.
All right, I think I have the next one. Some people are complaining about the back sound, so the bad sound. So hopefully it's not too bad. Also questions about whether you can get the slides. They should be available in the um, in the handouts, so you can download those. And then obviously there's also the opportunity to ask questions, which we'll take in the at the end. So let's go to the next one. So world hit by major health crisis as obesity drugs make people stop exercising. This is quite counterintuitive, but because we all have seen the stories and the headlines with the Eli Lilly, Novo Nordisk, with the stock price raising higher and higher and higher. The one I've put in here is Eli Lilly. Um, we all know that obesity is a big health issue. It's an epidemic in the world. A large part of the world is impacted by this, and that's why there's so much positive ness around these new obesity drugs. And the this outrageous prediction takes that idea and actually spin it around. So I've put in that this headline from um, from an article around this research from Stanford University that shows or indicating that it's lack of exercise, not the diet, that is linked to the rise in obesity. And people, humans are exercising less and less as physical tough labor has increasingly disappeared from the labor market as the economy has transitioned. We've got more machines, et cetera, and could point to the fact that we want to maybe skip exercising. It's not something we want to do, and so the counterintuitive idea here is that these obesity drugs will make the issues of obesity go away, and then why we don't need to exercise. But we know that there's a lot of health issues that come with less exercising. So some of the issues could be uh, you know bad heart conditions. It could be related to your muscles, weaker muscles, also related to your bones, etc. So that would be the counterintuitive angle to it here. We also, as we described with the little drawing here, that why would you have all these gyms being open when there's no need to exercise, because you can at least fix your the obesity issues with a pill. So that's the idea. And right now, if you look at the expectations, the expectation is that the fast food and the food processing industry and soft drink industry would be hit very hard by these obesity drugs. But maybe the exact opposite will happen. That at least is the idea we put forth in this outrageous predictions. And if we go to the next one, that's the is a very interesting one to say the least, and that's you, Althea, that are going to present this one.
Thank you very much, Peter. So the end of capitalism in the USA. So this outrageous prediction draws inspiration from what has happened throughout this year in the US. And the question we are posing is, what happens if 2024 is going to be a copy and paste of 2023? Therefore, the Federal Reserve will not be able to cut rates, and the reason because inflation will stay at current level, and in the meantime, fiscal spending increases because we are having a US election. Therefore, politicians will need to appeal to the masses. If that's the case, the stock market might remain buoyant, and the Magnificent Seven will be joined by other 5 companies and will become the 12 titans. To join the Magnificent Seven, we envision Novo Nordisk, Eli Lilly, LVMH, ASML, and JP Morgan. So what's happening if that's going to be the case? The problem is that US Treasury yields will probably continue to increase because more fiscal spending ultimately means more bond issuance. And already right now, if we believe that fiscal spending will remain, will not increase in 2024, we have to understand that approximately $800 billion need to be raised in the following years in order to pay interest on current US debt. So the problem that the US Treasury, the US government will face is that a cost of funding will continue to increase, and that's going to be an obstacle to fiscal stability for the US, and it will need to intervene in order to keep borrowing costs in check. What is going to do? Well, it's going to make taxes on US treasuries, is going to remove taxes on US treasuries, and that will mean that there will be a rotation from private sector to government sector, and what will follow is nationalization of key industry. Ironically, the 12 titans will continue to increase in value, and the reason for that is just because markets believe that those will continue to be outlier. They have quite a lean balance sheet, and they will benefit from lower US Treasury yields. And that's all for me. And now I will move it back to you, Peter.
Yeah, I think the next one, and by the way, there was someone that wrote that we put out the quarterly outlook. That's true. So, but that we're changing that so it's the right presentation. The next one I like very much, and I think it's if I was to guess, I think it's actually one of the outrageous predictions that could come true next year. So the headline goes like this: the generative AI deepfake triggers a national security crisis. There already been reports from Homeland Security, Pentagon, etc., that deepfakes poses a very key threat to U.S. national security interest. And in this idea, we propose that some criminal gang or even a rogue state, taps into these new large language models, generate a deep fake that is so convincing that it triggers the ciphering of information from a high-ranking politicians in a developed country, and that immediately triggers like a full stop, a big change to the AI industry. So right now, I mean, in the financial industry, we know what regulation, how that works, because of crisis moments, big money laundering scandals in the financial industry, the collapse in 2008, etc., caused a lot of regulation, and one of them being the know your customer. And that is not a concept that is fully understand or being regulated on the technology industry. So right now, everyone around the world can just tap into OpenAI's API and develop their own things on this technology. And in the event that we get a crisis moment like this with generative AI created deepfakes, then a lot of regulation will come to the AI industry very fast. And one of them could be that, of course, you should know which companies are actually using this technology. Right now, it's just up for grabs for everyone. Everyone is just talking about the upside, but not really a lot about the key threats. Although there was a little bit of discussion apparently since Sam Altman was ousted from OpenAI, but now he's back. So we're again back to only talking about the upside and how much capital and profits this can generate. So I really like this idea, and one of the potential outcomes in market could be that regular media companies will actually win out, because if this happens, then what can we trust on the internet? Can we trust the videos that we are watching? Can we trust the information that we are reading? What if people are not even saying that it's generated by AI? What if all the information on the internet is generated by AIs over time? Then information will just converge to being the same all over it repetitively again and again. Trust will disappear. So it's there are some dark scenarios around this, and also one of the market impacts that we have is that Adobe's share price will tank more than 50%, because of Adobe has a lot of the software that is used for creating these deep fakes. So this is a scary one, but unfortunately one of those that actually could turn out to be right. And one of the causes of any regulation in the world is that we always go through a crisis moment, and just like 2008 and the big money laundering scandal related to Russia here in Europe was a crisis moment for our industry. I think something around AI will be the definitive crisis moment for the technology sector that forces much more regulation on this industry. So this is really an interesting one. The next one is you, Ole. So I'll let you talk about this.
Yes, thank you very much, Peter. This one is written by our CIO, Steen Jacobsen. Basically, we are looking at this continued divergence in current account deficits between surplus and deficit countries. So the headline is deficit countries form a Rome Club to negotiate trade terms, and basically it's the result of a U.S. debt situation that has increasingly become uncontrollable. We're seeing the rising debt pile that has been added, even increased this year. We're seeing that around the world. So basically, the idea is that a group of 6 deficit countries form a Rome Club to cooperate on reducing the deficits by collectively negotiating new world trade terms with surplus countries. This is obviously upsetting the whole financial system, and a result of that, and that's where I come in, is basically that it could create a lot of safe haven demand for away from the bond market, and we've seen some signs of that earlier this year when yields were spiking high in the U.S. At that point, we actually saw gold prices rise at the same time. Normally, something that we don't see happening at the same time, but simply there's some worries about the health of the financial system. So this is basically what the market is what this one is looking for. And just taking a look at the debt levels, when the Paris Club was established in 1956, US had total debts of around $273 billion. Today it's around 33 trillion, and obviously an increase of 14,000%. So with other countries struggling as well, they obviously want to seek better terms with some of the surplus countries. And the Rome Club, as we envisage it, is going to be the US, UK, India, Brazil, Canada, and France. So we'll see. But again, the main impact would be a move towards safe haven in something like gold, silver, and cryptos. Thank you. What have we got? We have US election. John Hardy.
Oh, so you're picking on the American to cover the U.S. election now?
I do indeed.
I guess that's a fair game.
You got the insights.
Okay, let's look at this one. Unfortunately, I'm sharing the wrong screen for looking at this in a nice way, but I think it's really whatever you think. 2024 and a presidential election in general. Presidential elections can be seminal event risks in the markets and can mark key turning points potentially as well, and are a reflection and a pivot of history. So if we go back to the most recent election, it was Biden taking back from Trump, the Trump experiment having failed, at least at the margin, because there were just enough of the independent voters that voted against him to send Biden over the edge. It felt a lot more like a revulsion of Trump than a pro-Biden for that key sector. Again, we have this very divided U.S. society in the U.S. in the two camps. That's what the model we've come to accept. And it was just enough in 2016 to send Trump over the edge. And then that slice that doesn't want to join the one or the other extreme partisan camp decided that was enough of the in their minds the craziness, and we'll go for the safer hands. And now we've had another 4 years. And those 4 years have not really solved anything for what has been a very long-term corrosive dynamic in U.S. society, and especially the aggravation of wealth and income inequality. And Trump made a lot of noises about addressing this with a very populist message, but and to a large extent, it didn't really result in policy measures that delivered on reducing inequality. And meanwhile, for the first time since 1992, so for the first time in 30 plus years, we have a true independent candidate with, if nothing else, will serve as a complete spoiler for this election. Spoiler meaning that if it was just the two running, there might have been one result. The spoiler is the one that decides who wins this election. And our outrageous prediction argues that this spoiler could be so significant, this proves the spoiler that actually wins the U.S. election. Well, how could that be? Let's look at a number of factors here. We have a look at the lower left there. Polls show Biden hitting record low approvals for a sitting president. We are likely to have a recession dynamic developing next year in the U.S. Recessions are notoriously the sort of events that create that critical mass, that critical momentum and inertia for real change to happen. And we have Trump theoretically leading in the polls. The big independent slice of voters out there is generally probably more anti-Trump than anti-Biden. And the spoiler here, RFK, you see top right, actually leads in favorability. And below that, you see that he is actually outright leading, double underline outright, among younger voters. I think I've seen even down to 36 years old in the polls that he's outright leading, not just the 29 that's indicated, 18 to 29, that's indicated in that headline, I believe, from Fox News. So pretty amazing stuff. A couple of reasons why young voters. So who are young voters? They're millennials and Gen Z, so-called. I've got a couple of statistics on my screen in front of me. 70 cents are owned by millennials. That's people all the way up to their mid-30s and even a little bit more. They own 70 cents of wealth for every $1 that people of my generation, Generation X, owned at the same age. And similar to the baby boomers. So there's been a negative development for this. This is a generation that is losing out. It is also the largest by size U.S. generation. Quite unlike the demographics in Western Europe and most of the developed world, we have a U.S. Millennial generation, so those mid-30s down to in the early 20s, that is larger now than the baby boomer generation. And over the last 8 years since the first Trump election, when Trump won in 2016, those demographics have shifted very significantly because those older boomers are dying out simply due to the age, etc. And this means that we have a very different demographic picture. Young voters overwhelmingly are not Trump voters. Now let's go back and draw a couple of parallels with the prior experience with an independent candidate, third-party candidate. And that was Ross Perot back in 1992. I well recall this. I was on a college campus. I signed a petition to get the guy on the ballot at the time. He, despite a very odd election campaign where he largely spent his own money and a bit of contributions, and some very strange last-minute behavior where at one point he pulled out of the race, appeared to be pulling out of the race last moment, only to re-enter again in the very, very last moment. He managed to get, look at this, 18.9% of the vote, largely as a protest vote, and not as much because people thought he had a realistic chance of winning. Incredible in an era when there was far less, I would say, drama than you have now. But what are the parallels? There was a recession that year. Arguably, this was a recession that saw the big losers at the time, the blue-collar worker. The blue-collar working because U.S. industry was winding down, shipping off to Asia. You had the rise of Japan, if we recall, throughout the 70s and especially the 1980s. So this was a very large protest vote. It was very insular, isolationist, anti-North American Free Trade Agreement at the time. So those combinations, I think you see this time as well. You see Robert F. Kennedy aligning with Trump in terms of the isolationism. He's anti-war. He's pro-strong borders. You also have the recessionary dynamic. And I would even add to this, maybe even weaving in a bit on Peter's artificial intelligence points, not so much the deep fake, but the implications of AI. And this may not be the election, it may be the next one, but I think it's going to be an ongoing trend, is the power of AI to take over ever larger swaths of white-collar work. So now it's not just the blue-collar work that is displaced by technology and formerly simply by outsourcing it to Asia and elsewhere, and then I think increasingly by technology. And now we have white-collar jobs being displaced by technology. And what is the answer around that? It's certainly not a laissez-faire libertarian approach that wins the day. It's somebody that's selling the message that Robert F. Kennedy is selling, which is that we need to go back to our Democrat with a small d values. So he's very on message on a number of points that I think tap into a lot of resentments, especially for the young, the cost of education, treatment of student debt, peace, so anti-war, regulatory capture, how all of the U.S. major agencies have been captured by industry, and the environment, and the list goes on. So I think we could have a surprising challenger here. At its most outrageous, it results in an outright victory for Robert F. Kennedy, and then you have to wonder how the whole partisan picture really shifts, and how does somebody that's still voted into Congress on the one or the other party deals with having a president that is not firmly in one camp or the other. I think it would be a fascinating prospect, have profound implications, I think, for the power of anti-monopoly going forward, and especially for the big industries that make the most off of the public purse, things like defense, drugs, and healthcare, and others. So I think one of our more interesting, outrageous predictions, from my mind as an American, but one to watch for as we wind our way in the very ugly and long and drawn-out process of a U.S. presidential election. With that, I think I'll send it on to, we have one on Japan here. Who's picking that one up?
Yeah, that's me. So this is clearly an outrageous one, given the latest GDP report we got from Japan. Obviously, there's a lot of revisions all the time, so let's see whether it is as bad as the current one is indicating. But so this idea is that the 7 is the lucky number in Japanese culture, and it's called Japan's lucky number 7. GDP growth rate forces Bank of Japan to abandon yield curve control. It might very well happen that they abandon the yield curve control for other reasons, but we pinned it on this really outrageous prediction, which is the 7%. And I've highlighted here on the slide, as you can see with the orange line, what would constitute a 7% annualized growth rate in Japan. The country have hit that a couple of times in the past 30 years. There was a brief moment in 2000 during the dot-com bubble, then post the financial crisis, the rebound there, those years, and then we had again the rebound in 2020 as societies were reopening. So what are sort of the ideas and the underlying currents of this? Well, we have the war in Ukraine. I think that is accelerating not the deglobalization, but the reconfiguration, as I call it, of globalization, because a complete deglobalization would cause prices to increase too much in the developed world, because it is still cheaper to manufacture a lot of consumer goods outside Europe and the North American continent. The idea in Japan is that with a lot of companies and countries, in particular the US, pulling more and more of their supply chains out of China, there other countries must fill in that gap, and we know the usual suspects, which are India, Vietnam, Mexico, Indonesia, some of those countries that are really benefiting from these redirections of foreign direct investment flows, and then Japan being a knowledge center and a country in close proximity to some of these other manufacturing hubs in Asia, have a very high educational standards, etc. And it looks like Japan is being used as a country and a platform for creating semiconductor manufacturing, other very high and advanced chip production, etc. So the idea here is that this reconfiguration of deglobalization trends will benefit a country like Japan, and in particular in those areas that are very sensitive. So everything related to semiconductors and AI, and that investment boom will cause GDP growth to accelerate. The very weak Japanese yen, as a function of Bank of Japan's monetary policies, also make it cheaper to set up manufacturing in Japan. So those are some of the ideas behind this one. And obviously, if the Bank of Japan was to significantly tweak or abandon altogether their yield curve control, that would set in motion some very, very dramatic flows in financial markets, to say the least. And obviously, dollar yen, euro yen, Aussie yen are some of those pairs that would decline pretty significantly in that event. So check out this one. I think that's an outrageous one, but it could happen in a freak moment for the Japanese economy. The last one is called luxury demand plunges as EU goes Robin Hood introducing world tax. You might be wondering, is that even possible? Well, there is actually what is called a European Citizens Initiative already on the block. It was introduced back in July and has been adopted by the EU Commission as a proposal by citizens that will be discussed in the EU Commission. It is targeting the individuals. There are 500 of those in Europe with a wealth above €1 billion. And one of the ideas is that a 2% tax rate on capital on wealth for this group will only limit the growth rate of capital for this group. It's not something that is going to see their wealth plunge, because capital grows at a significantly faster rate than 2%. So it just takes down their growth rate, and that, I think the growth rate argument is really well captured in the graphic you have in the lower hand left side corner there. Growth rate is just, especially in the era of globalization with capital moving around freely, growth rates, and that has been shown as well in the famous book by Piketty, Capital in the 21st Century, and in the 20th century, and that argument is one of the main reasons. Then also there was a huge funding needs inside the EU on the green transformation. We have the war in Ukraine, so there's a lot of arguments for this. It's definitely outrageous, to say the least. In the case that it was to happen, the whole luxury industry, which has been one of the strongest industries Europe has had to offer the equity market in the past 2 decades, would obviously suffer. So we have the market impact being that Louis Vuitton share price would decline pretty significantly, more than 40%. As we know, there is a significant link between wealth and income inequality, but also the size of wealth in a given area, to the demand that you see for high-end luxury goods. So that was the rundown of all the 8 outrageous predictions, and as I've said earlier, you can ask questions and we'll take some of those. I think it's important to state here up front that they are called outrageous predictions because they are outrageous. So in the meaning of that word means that the probability of these things happening is very low. These are not our base case scenarios. These are not our ordinary predictions for the world economy. That's very important to state. So there's a question here. Can you outline briefly why you think oil would hit $150? I'm pretty sure, Ole, that you don't have a target for the oil price to go to 150. But what would it take for it to go to 150?
Well, it will most certainly take a market which is not hitting a hard landing, that we avoid a recession, that China's stimulus will continue to add demand to the Chinese economy, and then obviously that OPEC maintains stability or maintains unity and continue to keep supply tight. We've seen this year how a significant amount of cuts has not really yielded any significant upside to the price. So it is a question of OPEC unity and avoiding a recession, and then obviously hoping that a succession of rate cuts next year will help soothe the economic worries that we see. So very unlikely, to say the least, at this stage. Perhaps in a few years' time, as production starts to slow, we may see prices reach those levels, but very, very highly unlikely next year, that's for sure.
I think I'll pick up one, Peter. What do you think the Democrats will do if RFK Jr. begins to pull huge numbers in 2024? It seems to me the Dems are trying hard to exclude everybody else from them than Biden from achieving electability. Spot on. It's been a very undemocratic process. This whole primary season, where Biden or the Democratic National Committee essentially decided it was not interested in challengers, and because RFK was shut out so badly, and because of that, we have the situation where now he's a third-party challenger. I think it's most likely that if it is decided that he's polling so badly and his favorability is so low, he might be convinced to step aside, but then they would do some kind of very undemocratic appointing of some figure. But it would be a highly criticizable process, I think, if they did such a thing. There's been a lot of talk that this person could be Gavin Newsom, who's a politician from California. But that's, to me, the most likely route, rather than an outright democratic process. If you think about it, the very first votes that take place in so-called primary season happen already here in January. We have Iowa and New Hampshire. The vote happens on the 15th. The Democrats, again, in signs of them losing their democratic small d nature, saying that we're not going to recognize that vote in Iowa until the early March votes in other states. That's where Biden caught his stride in the 2020 election, because he lost some of the early votes to other candidates. So they're almost rigging this. It seems rigging the primary season to avoid any challengers. It's just a big own goal for the party, and they're clearly trying to cater to the establishment, and it's all feeding, I think, RFK's chances in sort of a reflexive process. So the only thing that can go wrong, I think, is that RFK does something to hurt his own chances more than the Democrats do something to help their own chances. I could be proven wrong, but I think that's the dynamic that's at foot here.
All right. I will just talk very quickly about the latest question we got, and then Ole, there's something for you on precious metals, which you can look in the question. So when I'm done, you can talk about that one. There's a question here from Christoph. What about the highest probability scenario in 2024 beyond recession or its impact? Well, we're here to talk about those that have the least probability, but in essence, there's always the flip side of those things that are the least probable. So one way to think about markets is that they always price consensus, right? That's embedded in the pricing. And if you look at the consensus going into 2024, yeah, the market is pricing and building a very strong narrative that inflation is under control and the victory lap will be justified by central banks, and that policy rates will be dramatically cut next year. So that I would argue is the high probability scenario right now. So if the whole point in markets is that where you can make money is that where you have a different opinion than what is the consensus. So if you don't subscribe that inflation will be under control, but in fact it will show to be stickier, then the central banks don't want to be pulled around in the arena by the markets, and they will actually do stand hard on the higher for longer narrative, then you'll see huge turnaround in sentiment and hiccups in market next year, and those hiccups are certainly opportunity sets that you can gun for if that the most likely scenario doesn't pan out as expected. So that's a different way of looking at things. But let's stay true to our outrageous predictions presentation here. Ole, we did the one you did on the Club Rome is actually related to gold and crypto and silver. So maybe put a little bit more color on that.
Well, for those of you who read our output, you probably heard me writing about a Santa rally last month. We did indeed see a very explosive Santa rally at the start of the month, which has since deflated, simply because all the docks have not been lined up in the proper road just yet. But we think they will be lined up into 2024, basically supporting a continued move higher to record high levels in gold at least, while silver and platinum enjoy the tailwind from that move. The driver being several. The one that is the constant underlying provider support is the continued central bank buying 1,000 tons, more than 1,000 tons last year, perhaps equaling that this year. That basically dwarfs the selling we've seen from ETF investors, which has also been cited as a reason why gold is struggling to move higher. Once we get the funding cost of holding positions in non-coupon interest-paying metals down from the first rate cuts and forward from that, and when we potentially also see real yields start to come down, then we have the right line of order, and that should support further gains in the coming year. Then, obviously, we did talk about the bond issuance and the worries about something breaking, and I think that will continue to be an underlying theme as well. But for now, the speculators have been in the driving seat, both when they got wrong-footed to the downside in September and now recently wrong-footed to the upside. That basically means they're currently getting out of positions. So from a slightly shorter to medium-term perspective, these potentially could be an area of interest for people who missed the first move. But as I said, this is a patient game. We're not yet clear. We need to see a solid path towards rate cuts before we see the next move to the upside.
All right. I don't see any more questions really related to the outrageous predictions. So I think we have also talked for 40 minutes. I hope you found it inspiring, and they're pretty. I think they're pretty cool. And as I said, my favorite one is the deepfake one, the AI deepfake. So, but Obviously, I don't hope it happens, but I think there is a fair chance for that. But you can read all of them on under home.saxo under inspiration. You can clearly see there's a link there, and when you go to that page to our outrageous prediction, you can read all of them and download the full report. It's always a fun exercise. It's a fun thing to do, and remember that the exercise here is to entertain the mind and think about improbable events that could happen, because it's always where we're the most blind to things that we had never thought about. So that's the idea. I hope you find it interesting, and we'll be back with another presentation from Saxo at one point. But we're approaching the holidays, so I'll wish you all a great holiday and a happy new year when you get there. And yeah, have a good day. Thank you for listening.